to the economy. The country's gross domestic product shrunk by 7% in 2020 compared to a 0.2% drop in 2019. Stats SA says the drop was primarily driven by decreases in manufacturing, trade, catering and accommodation. And this is partially due, obviously, to the COVID-19 lockdown regulations. To talk more about this, we're joined by Citadel Chief Investment Officer George Herman. I believe you can hear us now. Not good figures, were they, George? What does this mean for us, this contraction in the GDP?
Good morning. Yes, horrible headline number, that the annual number of -7%, worse than 100 years. So yes, that's terrible. But there is some good news in there. That fourth quarter number came in better than what was expected, 6.3 versus 5.6 expected. That is good news and builds on a bit of momentum going into 2021. And at least in 2021, the expectation now is to grow around 3.5%. So a decent bounce back after a very tough 2020 indeed.
Does this suggest that the worst is over?
Yes, the worst is most definitely over, and the world is looking forward now to a post-COVID world where we open up and where consumers can get out. Theoretically, there's a lot of pent-up spending that needs to take place as certain industries and specifically services reopen. So there is an expectation that we will find a bit of a consumer boost and that the economy will look a lot better. South Africa, unfortunately, grows a little bit slower than the rest of the world in that resumption, but still a lot better, yes.
Okay, I'm all for the enthusiasm, but just if we could hold it for just a second. Ratings agency S&P says South Africa's credit rating could slip further into junk status if it fails to bring about adequate economic rebound. Are we in a position to rebound enough to appease S&P?
No, that is unfortunately the problem. The South African budget was predicated on a very positive set of assumptions. One, that revenue grows by this growing economy, and on the expenditure side, that expenditure is contained, especially in the wage bill. So those are the two main variables. So yes, GDP came out a little bit better, but the expenditure side is going to be under pressure. So yes, you're right. If we look past the positive signs of the GDP and we look into the debt scenario of South Africa, yes, we have a very tough medium-term 3-year period ahead.
S&P also raises the sort of mixed messages coming from the country. They talk about the concerns about property and how that's going to play out. When it comes to mixed messages as well, we've got the SOE. We're just hearing that the post office can't afford to pay rent. Many of them are closing. How does South Africa deal with what's happening on the ground here? You know, we've got these broken SOEs. We refuse to privatize them. We keep throwing in money that we don't have. Where does it stop?
It has been a number one on the list of business communicating to government is give us certainty. Give us policy certainty. Don't make big promises and don't deliver on them. Rather make small promises and deliver on them. And unfortunately, the structural reforms, a whole list of which has been known for a long time, is unfortunately not taking place. SOE reform, the spectrum auction again delayed, you know, and there's the excuse on excuse on excuse. And unfortunately, the list you cited there on SOEs having problems, nothing of that has changed or being addressed. So the SOE is still a major ball around the ankle of government's finances.
Doesn't mean they're going to do anything about it, right? Tell us about what the drivers will continue to be. We know that household expenditure and exports, some of the biggest contributors. Is this likely to stay the same? What else is going to jump into that basket?
Exports has been magnificent for us, and in fact that's been the boon for the rand during 2020. We had this dual benefit of the stuff we export, minerals, commodities, the prices of those went a lot higher, while South Africa's largest import, oil, became a lot cheaper. And that created a fantastic combination for South Africa, a surplus on the trade account, and that really supported the rand. Unfortunately, now commodity prices have flattened off and the oil price has risen dramatically, so that benefit is disappearing. We'll have another fuel price hike come the end of this month, and slowly but surely that does start eroding. So from an export perspective, minerals are still the top export, and our motor vehicle manufacturing sector is still doing nicely, so that really did help us, but it's not going to accelerate dramatically from here.
But George Herman telling us that the worst is over. Thank you. UK's